Welcome to The Property Perspective, a podcast by Knight Frank Australia. We'll share expert analysis from industry leaders, focus on key trends and forecasts, and bring you the latest topics shaping Australia's property market.
Hello and thank you for joining us on the latest episode of The Property Perspective by Knight Frank Australia. I'm Emily Relf, Head of Living Sectors for Asia Pacific for Knight Frank, and I'm joined by Ben Burston, Chief Economist in Australia, and Tim Holtzbaum, Head of Alternatives. And today we'll be discussing Beyond BTR. Co-living is a bit of a grey area in terms of what actually is it. It kind of sits quite close to hospitality, service apartments in terms of the tenure being shorter, the churn being much more, amenity levels being quite a bit higher. Can we just, and Tim, maybe this is one for you to touch on exactly what is co-living product in Australia? Who does it appeal to? Who's living there? And what's really important for a developer and operator to think about when looking at their co-living assets?
Yeah, as you mentioned, we do have versions of co-living in Australia, be it the service apartment style living or what was termed as the new age boarding house assets that had been developed over the past 5 to 10 years. But co-living is really probably an evolution of a purpose-built student accommodation asset, really, whereby you have a large number of call it furnished studio-style apartments, providing kitchenette, bathroom, bedrooms, real self-contained living environment, say anywhere between 25 and 35 square metre sizes, with then a communal ground amenity offering to the occupants of those apartments, providing access to commercial-grade kitchens, TV areas, co-working style areas, outdoor spaces with barbecue areas. So a higher emphasis on the kind of social aspect of what it would be to live in a building of anywhere between 50 through to 250 furnished studio-style apartments. So from a demographic standpoint, they're really targeting kind of early to late 20-year-old demographics. Now, we do see some tenants who are slightly older than that and some that are slightly younger. However, I guess the broader appeal of the co-living asset is that A, is a furnished option, but B, you can also get shorter tenures within these particular assets. So our typical lease tenure here in Australia for a build-to-sell style apartment, or even build-to-rent, for example, would be a 6 or a 12-month lease. So in co-living, we'd see a 3-month lease offering with the ability to then roll that on a 3-monthly basis, or take a 6, 9 or a 12-month lease. So it provides flexibility for tenants. It provides a furnished option for tenants, which is pretty uncommon in the Australian market, unlike places like London, for example, where the majority of apartments are furnished. And we're seeing a really strong take-up of that flexibility offering, and also the furnished offering in our market.
Okay, so because the nature of the assets, maybe being a bit smaller, dense, studio-led, is there more opportunity for developers to convert assets in really strong central city locations where perhaps build-to-rent wouldn't work, where you might need a much larger site? Where are opportunities coming in terms of site availability for co-living assets?
Yeah, I think that's one of the strongest appeals for capital looking to get into the space at the moment. I mean, it's been pretty well reported that getting BTR assets to work in a place like Sydney and close into Sydney CBD has been quite challenging, just because of the size and scale of the assets that you need to be able to develop, and in markets and fringe markets where land holdings are small and amalgamations are challenging, to get that kind of scale of north of 10,000 square metres of gross developable floor area we see the co-living assets being able to be put together on either just a single acquisition basis, where you can hopefully then achieve say a 5 to 10,000 square metres of GFA, which would give you a perfectly well-designed co-living asset in a really strong market like Sydney CBD or the Fringe or the Inner West. So the capital is really very positive around being able to get access to a place like Sydney CBD, but also Brisbane markets as well, and Melbourne too.
I think that's a real positive, but also probably points to a limiting factor with co-living, or up to this point, which has been, how do you scale it? So for an investor, for an operator, scaling with co-living assets that are 50 units, 100 units is much more challenging. So I think perhaps, is it right to say that we'll see the market being led by developers that already have living BTR, perhaps portfolios, student portfolios, that then kind of pivot to co-living and add that as a living subsector, sort of a string to their bow?
Yeah, I think both from a development standpoint, but also from an operational standpoint. There are teams that have been built to work on those particular asset classes, whether they're hotel service department or student accommodation or BTR. So if you've got the personnel and the skill set internally, then if capital is available, why not consider something like co-living as a standalone platform to be developed out, and one that, scale may be challenging, but it keeps the teams, churning over and using that skill set that you've already spent the last 3, 4, 5, however many years building up internally.
If we can just touch on student accommodation, I think we've really seen some positive rental growth driven by a strong return in students post-pandemic. Ben, can you just walk us through a little bit in terms of what that looks like and what we see going forward for the student market in Australia?
Sure. Well, I think we've really seen an about face, whereas during the pandemic, for obvious reasons, we saw this huge drop-off in student numbers, a lot of uncertainty, and naturally a cessation of planned development activity in the sector. And so from a peak in terms of international student enrolments of over 400,000 in 2019, we saw a steep drop, and there was no supply being added to market, and uncertainty around the future of those sites that were sort of earmarked for student. People probably were looking at other living sectors at that time, but over the past 18 months, we've seen a really quick comeback. We're now back to where we were effectively. The latest numbers show that overseas student enrolments in the higher education sector, I should qualify that, are back over 400,000. And so, in percentage terms, that's a huge percentage increase, but in a sense, we're back to where we were, and then there's in all likelihood, we'll continue to see further growth. And as often happens in property, not just in student accommodation, it takes a while for the supply side then to respond to that. And so whereas we've seen this sudden upsurge in demand, we haven't yet seen a material supply response for purpose-built student accommodation. And as a consequence of that, we hear anecdotally that overseas students are an important category of the demand base for BTR schemes. And so I think that testifies to the fact that there is then a place in the market then for them. I mean, that's a higher priced product. We're hearing that they're prepared to go into that, and I think that testifies that were there to be a further rollout of purpose-built student housing, and then I would also say co-living assets as well, that there will be a demand base for that.
I think we still, on the capital side, Tim, particularly see investors seeking student accommodation, I think, for that higher return, but also the resiliency that the sector's shown over pandemic and economic downturns.
Yeah, certainly. I mean, it's a very mature sector in Australia now, with most of the assets that aren't owned by universities being owned by 5 or 6 major institutional investors. So they certainly had to weather the storm through COVID, but they'll happily report that most of their assets back to near 100% occupancy now going forward, and they've certainly been in a mindset for the last 6 to 12 months of acquiring new sites And I think that probably creates a little bit of a problem around supply in that whilst when we saw the sector roll out 10, 15 years ago and really starting to take hold, we had a lot of private developers get into the sector by doing 1, 2 or 3 assets and creating mini portfolios that ultimately ended up being sold into much larger institutional investors. But we're probably not seeing that this time. It's mostly being driven by the major investors and developers in the space. And so we're sort of unlike maybe BTR and also co-living now. We're not seeing that kind of emergence of the next wave of private student accommodation style developers building out asset after asset that will ultimately end up being sold into much larger institutional investors. So, it tends to be a market that's dominated by the select few now.
So difficult to access for investors looking to get into it. I mean, where are the transactions going to come from if they're tightly held in these larger portfolios?
Yeah, limited transactions will transpire out of existing assets. I mean, we did see one late last year, the Student One portfolio, which was about 2,500 bed portfolio across 3 different assets up in Brisbane, which was acquired by Blackstone. We've actually got one coming to market shortly, which is a smaller privately held portfolio down in Melbourne. But yeah, there are limited opportunities to acquire existing operating assets that aren't already owned by some of the larger institutional investors. So we need that kind of next wave to start coming through. So similar to the BTR and the co-living space, we're now back in a development-led phase of life cycle. So that obviously will take time for some of those new assets to come online, stabilise, and then transact in time.
So I think kind of when we look at a summary, we can see that the fundamentals across all the subsectors we've touched on, from BTR, co-live and student, are absolutely there in terms of demand and the rental growth prospects, but it's accessing opportunities and it's kind of delivering over the next couple of years with some of the challenges we've talked about that's really going to kind of potentially slow the growth down. Is that fair to say, Ben?
I think it's fair to say yes. Certainly the demographic story is there. The demand-supply balance is positive. When people are looking ahead at income growth projections, they can do so with confidence. But by the same token, I mean, coming back to our the remarks, we interchanged on interest rates right at the outset. That's a challenge, and so that means that not only are funding costs higher, it means return targets are higher, and so developments need to hit higher targets compared to what they would have in a low interest rate environment. And so there's a to and fro there. So yes, the long-term outlook is positive. The markets are undersupplied, and the tenant base across all of those living sector asset types looks like it's going to continue to grow, but it just takes time to get that supply response through. I'm confident we will. It just might take time, and in the meantime, this is why it's such a policy challenge, and we read in the newspapers all the time about that the shortage of rental accommodation across all these living sector assets.
With a view to the capital markets, though, however, I think one of the positive things is we do have a development fraternity and a large number of groups in all of those different asset classes here in Australia that have set up businesses to try and move into this space or continuing out to develop out their strategies. And from a capital markets perspective, while we haven't seen a huge amount of volume come into the market in any way, shape or form over the past 12 months, a lot of work has been done by this offshore capital on the Australian market on these different asset classes. So we feel like it's well poised for this partnering process to start transpiring in the early and mid parts of 2024, which I think is really exciting.
Yeah, absolutely agree. It feels like last year was an education phase for a lot of groups that were pivoting away from traditional sectors, and this year allocations have been set towards Australian living, and it's absolutely exciting, but they need the experienced partners on the ground to help them execute their strategy. So, I think a busy year ahead. I'd just like to, we've talked a lot about kind of the issues around affordability and, how the government needing to put policy in place to address these issues. Is affordable housing kind of a subsector we're going to start to see a big growth in, Ben?
I think it's widely recognised it's needed, but by nature, most types of affordable housing are going to need some level of policy inducement or straight out subsidy from the government to execute. And so, despite the high target that we've put in place for the overall level of delivery, we're yet to see really strong financial commitment to sort of back that up, to make sure to safeguard, to make sure that affordable housing is going to come through. So it remains to be seen. If it's left entirely to private developers, it's not. It's obviously a less economic proposition from their perspective, and so it's unlikely to happen unless we see significant inducement on part of government.
Yeah, and maybe a year ago we wouldn't have talked so much about co-living. In a year's time, might there be a different subsector we're talking about? Maybe single family, or some other subsector of living that is another way to address the housing crisis. Is probably a too strong word, but in Australia, Tim, what do you think? What can we learn from our US colleagues and our UK colleagues?
Yeah, I think single family housing, but one sector to look at, which is established here, is the land lease community sector, which has 8 to 10 really strong players in that market, and they're continuing to acquire new sites and build out portfolios and really offer a lower cost housing to seniors within our market in locations not just focused on CBD style areas. They are, this is regional style housing, which has been an evolution of the manufactured housing industry. Was arguably the strongest living sector over in the US at the moment. So I think we're going to continue to see an expansion and evolution of that as that product starts to come online, and those local groups start to refine that offering for that style of demographic. So that's a really exciting one to watch from my perspective.
Yeah, I agree. I think it's the fundamentals there are really exciting. Okay, let's wrap it up. Ben, from an economist point of view, what's the outlook for living for this year?
Look, I think the outlook is for continued growth. I think that notwithstanding some of the challenges that are there, as Tim mentioned, there's a lot of pent-up capital looking to execute in the sector. There's a lot of appetite for that. I think not only from the tenant perspective, I think there's also an appetite from government to see an acceleration in supply, and I think it'll become increasingly apparent that there is a need for a thriving living sectors ecosystem across multiple asset types, and I think we'll see further efforts on the planning front to sort of put that in place. And then you mentioned the economic perspective. I think, yes, I think through the course of the year, again, the outlook's likely to become more positive. I think we're not expecting that we'll see interest rate cuts as quickly in Australia as we might in other countries, but certainly by the end of the year, even if we haven't seen cuts, there'll be a sense that we're a lot closer to that time. And I think that the financial backdrop there is going to become more helpful at the same time as the debate on policy and planning issues is going to become more urgent. And I think that will, as I mentioned, encompass some recognition of the need to support the sector, if not financially directly, then through making sure those planning frameworks are accommodating.
Brilliant. I agree with all of that. And Tim, you and I have got some exciting deals, hopefully, which will be going through in the next couple of months. And so do you kind of reflect that positivity that Ben's talked through?
Yeah, I certainly do. And I think coming off the back of the escalation cycle that we've been on from an interest rate standpoint, I think now that we're sort of through a large portion of that, investors can start getting comfortable with this notion that their debt costs aren't going to be uncapped forever, and they can start taking a view as to when they're going to jump back in. But I think the emphasis is going to be on, to your point, previously, partnering with groups that can get their money into the market sooner rather than later. So there's a real need and a push to, if we are going to commit, when can we start to see some deployment of that capital? So I think the onus will be on groups with particular sites, either on balance sheet or under control, and with that capability around the OpCo piece, because all of these living sector asset classes are really centred around the operational piece and using that operational piece to drive performance in your net operating income. So that is a really strong part of the investment thesis.
I absolutely agree. I think transformational year ahead in terms of activity in the sector. So I look forward to having another chat in maybe 6 months' time and seeing if our predictions are right. Thank you very much for tuning in to the latest episode of The Property Perspective. Hopefully you found this conversation insightful. If you'd like more information, please do reach out to Ben Burson, Tim Holtzbaum, or me, Emily Relf. Thank you again.
Before you go, subscribe to our channel so you don't miss out on the next episode of The Property Perspective, when we'll be back to share our take on more key trends and topics shaping Australia's property market. You can also follow us on LinkedIn or visit our website at knightfrank.com.au for more information. Thanks for tuning in. It may be the end of the show, but we're always your partners in property.